valuation in the short term is useless. Okay. But valuation in the long term, meaning 7+ years, is perfect. So it's pretty easy to sit back and say that stocks are overpriced and rich, and your expected returns over a 7 to 10 year period are probably pretty modest. But that doesn't mean you shouldn't be invested. And there are many stocks within the stock market that are not expensive. So, it's like I said, it's a market of stocks, not a stock market. And that's the way we've been approaching it for the last year. As you know, we've been less focused on the index level and much more focused on trying to be in the right places and try to help people outperform the index, which is really our job.
Hey, Mike, you recently upgraded the financials, and we saw some good earnings just a few days ago from some of the big financial players. What's the call there on financials these days?
Well, that was definitely part of it. So, we noticed that going into earnings season, expectations had come down. A lot of the bigger institutions had lowered expectations. So it was an easy bar to jump over, easier than others even. And, with the bull steepener that's going on in rates since the labor market came out, that's actually quite positive for big banks. And so that was an easy call in many ways. It's worked out so far, knock on wood. We do think there's follow through because from our data, it shows anyways that most institutional investors are still underweight the sector. And I think so financials, at least the large cap quality financials, look to be a good place to be still.
You may have noticed we've got an election coming up in 2 weeks. When you talk to your clients, how do you kind of frame that in the short term here and maybe even the intermediate term?
Yeah, I mean, the election has definitely taken a lot of the air out of the room as it usually does at this time of the contest. It's very closely measured by the polls, not as closely measured by the betting sites. As you know, it's sort of 60-65% Trump now. Right. And the market is kind of taking notice to that. So what I would say is that the market has definitely moved into sort of a Trump victory, if not a Republican sweep victory. And the stocks and areas of the market that would do better, and financials is part of that, by the way, under a Trump win, has started to perform. And so I think the setup now is such that if the market plays out or if the election plays out the way the market's expecting, there's probably limited upside in those areas that will do well under a Trump victory. And I think the surprise would be is if Harris wins, then some of these trades are going to have to unwind. So this is really front and center right now for the next 2 to 3 weeks. I think this is probably 50 to 60% of the conversations we have. People are trying to just manage this. And then once the election's over, I think then the market will look forward to, okay, what should I be owning now that this event is behind us into 2025?
Mike Wilson, I'm going to go to the heart of the matter, which is you were cautious on the market while we had a leg up in this 2-year, whatever it is, bull market. But the great Mike Wilson reality is you were invested. I didn't see Mike Wilson timing the market. In this bull market, forget about shorts. I mean, trust me, folks, I've been short and wrong. I've enjoyed that feeling. Good morning, Jim Chanos, the giant of all this. But Mike Wilson on market timing. If one thing we've seen here, Mike, it's just a brutal exercise, isn't it?
Oh yeah, there's a whole graveyard of people, of market timers. We do it as part of our job. I mean, we're asked by clients to kind of, whether it's the S&P 500 or sectors or stocks. I mean, that's our job. And that's most, asset managers' job is to try and time when to buy certain stocks or do certain things with their investments. And I mean, look, sometimes we get it right, sometimes we get it wrong. I would say we had a stretch where it felt like we got everything right. And of course, that never lasts. The good news about investing is you can always change your mind, which we've done. And we've, raised our targets and we've changed our strategy to deal with what the market's giving us. And that's really the game, is just take what the market gives you. Don't fight what the market's telling you. That's the best analyst in the world, is what the market internals are saying. We use it as part of our process, actually. And I think that's the best way to be, is just be humble about it. And don't be afraid to say, hey, we were wrong. I mean, like, I think some people are expected to be right all the time, and nobody is. And being wrong is not a sin. It's just, staying on the wrong side of things for too long is a problem.
But Paul, the heart of this is Wilson's playing. He's participating in the market, say with Gina Martin Adams and Brian Belsky coming up and all. These people that are go to cash. I mean, come on. In this bull market, they've been wiped out.
Yeah, I absolutely. And don't try to time the market, is what we've heard from the pros, including Mike Wilson. Mike, as we think about going into 2025, should we be focusing I mean, what's going to drive this market? Is it going to be the Fed and the parlor game that Tom hates to play, or is it going to be good old fundamental earnings and fundamentals and that kind of thing?
Well, it's all the above, but I think the thing that we're focused on right now, anyways, is look. We've been in this world of fiscal dominance for a while. We've gotten that right from 2020 on. We traded it really well at the beginning. We didn't trade it well, so to speak, in 22, 23, or in 23 in particular, and even into this year. But I think the consequences of that now are going to come front and center. And what I mean by that is what we're focused on is, the dollar and rates. Does that come back into the picture again? Which then makes equities, vulnerable to a correction at the macro level. We'll see, but I think that's going to be like right now. What we saw in the last couple of days is rates are breaking out above the 200-day moving average. We're seeing actually term premium come back into the market. The dollar has been very strong, and that's a governor on liquidity. So I think that's the thing we're going to be watching going into 2025. And of course, what we've been waiting for is this reacceleration that seems to be elusive. And so what we need to see is growth accelerate next year. We have acceleration in our forecast, 12% earnings growth for next year after about probably 7 or 8 this year. So that is good, but that's price. I think we need to see more than 12% earnings growth next year to get this market to really power higher at the index level.